Item 2. Management's discussion and analysis of financial condition and results of operations. Founded in 1951, Jack in the Box Inc., the company, operates and franchises Jack in the Box quick service restaurants. As of April 12, 2026, we operated and franchised 2,128 restaurants, primarily in the western and southern United States, including restaurants in Guam and in Mexico. We derive revenue from retail sales at company-operated restaurants and rental revenue, royalties based upon a percentage of sales, franchise fees, and contributions for advertising and other services from franchisees. On October 15, 2025, the company entered into a stock purchase agreement, the purchase agreement, with Yadav Enterprises, Inc., a California corporation, buyer, and Anil Yadav, buyer guarantor, to sell to buyer all of the issued and outstanding equity interests of Del Taco Holdings, Inc., a Delaware corporation, Del Taco, which owns and operates the company's Del Taco restaurant operations, for an aggregate purchase price of $115.0 million in cash, subject to certain closing cash, working capital, debt, and transaction expense adjustments. The Del Taco sale closed on December 22, 2025. Company restaurant sales decreased $0.4 million or 0.4% in the quarter and $2.2 million or 1.0% year-to-date compared to the prior year. Same-store sales at company-operated restaurants decreased 2.8% in the quarter and 3.9% year-to-date compared to a year ago. Food and packaging costs as a percentage of company restaurant sales increased 1.1% in the quarter and 2.7% year-to-date compared to the prior year, due mainly to commodity inflation and unfavorable menu item mix, offset by menu price increases. The year-to-date increase was also due to a non-recurring benefit from a new supply chain contract in the prior year. Commodity inflation was 5.0% in the quarter and 6.3% year-to-date, with the greatest impacts in beef, tacos, produce, and beverages. Payroll and employee benefit costs as a percentage of company restaurant sales increased 1.8% in the quarter and 1.9% year-to-date compared to the prior year, primarily due to a change in the mix of restaurants. Labor inflation was approximately 1.5% in the quarter and 0.7% year-to-date for the current year. Occupancy and other costs as a percentage of company restaurant sales increased 0.4% in the quarter and 0.8% year-to-date compared to the prior year. For the quarter and year-to-date periods, these increases were primarily due to sales deleverage and higher rent. Franchise rental revenues decreased $5.8 million or 7.5% in the quarter and $14.2 million or 7.7% year-to-date compared to the prior year, primarily due to lower percentage rent of $2 and $8.4 million, respectively, driven by lower franchise restaurant sales, and a decrease in rent revenue of $1.7 million and $3.9 million, respectively, due to fewer franchise restaurants. Lower lease termination fees of $2.9 million in the quarter and year-to-date also contributed to the decrease. Franchise royalties and other decreased $2.7 million or 5.9% in the quarter and $7.5 million or 6.8% year-to-date compared to the prior year, primarily due to lower royalty income of $0.7 million and $4.2 million, respectively, driven by lower sales, and a decrease in royalties of $0.8 million and $1.8 million, respectively, due to a decrease in the number of franchise restaurants. Franchise contributions for advertising and other services revenues decreased $2.5 million, or 5.4% in the quarter, and $9.1 million, or 7.9% year-to-date, compared to the prior year, mainly due to lower sales and a decrease in the number of restaurants, driving marketing contributions lower by $1.0 million and $0.8 million, respectively, for the quarter, and $4.7 million and $2.0 million, respectively, year-to-date. Franchise occupancy expenses, primarily rent, decreased $1.1 million or 2.2% in the quarter and $2.7 million or 2.3% year-to-date compared to the prior year. The decrease was primarily driven by lower operating lease costs of $1.3 million in the quarter and $3.1 million year to date due to the decrease in the number of franchise restaurants. Franchise support and other costs increased $0.2 million or 7.0% in the quarter and $0.7 million or 10.5% year to date compared to the prior year. The quarter increase was primarily to increases in bad debt expense of $0.7 million. The year-to-date increase is due to increases in bad debt expense of $1.2 million, partially offset by decreases in digital fees of $0.8 million. Franchise advertising and other service expenses decreased $2.4 million or 5.0% in the quarter and $7.9 million or 6.8% year to date compared to the prior year. The decrease is primarily due to lower sales and fewer restaurants driving lower marketing expenses. Depreciation and amortization for the quarter ended April 12, 2026 increased $2.9 million in the quarter and $4.1 million year to date compared to the prior year period, primarily due to increases for new technology assets placed in service and new company-operated restaurants. Advertising costs increased $0.1 million in the quarter and $0.8 million year to date compared to the prior year, primarily due to an increase in expenses related to opting into third-party digital sponsorships, partially offset by a decrease in company-operated restaurant sales in the current year. The cash surrender value of our company-owned life insurance (COLI) policies, net of changes in our non-qualified deferred compensation obligation supported by these policies, are subject to market fluctuations. The changes in market values had a favorable impact of $1.6 million in the quarter and $5.4 million on a year-to-date basis compared to the prior year. Share-based compensation increased by $2.4 million in the quarter and $2.9 million year-to-date compared to the prior year, primarily due to lower forfeitures in the current year. Litigation matters decreased $1.6 million for both the quarter and on a year-to-date basis as compared to the prior year, primarily due to the timing of litigation reversal relating to the J&D Restaurant Group. Insurance increased $0.1 million in the quarter and decreased $0.6 million on a year-to-date basis compared to the prior year. The year-to-date decrease was primarily due to group insurance reimbursements received in the current year. Included in the SG&A amounts above are income from the Transition Services Agreement (TSA) following the Del Taco sale of $0.6 million in the quarter and $1.5 million on a year-to-date basis in 2026. The TSA period has since concluded as of the end of the second quarter. Other operating expenses net increased $1.2 million on a quarter-to-date basis and $6.7 million on a year-to-date basis as compared to the prior year. For the quarter, the increase was primarily due to $2.7 million for proxy contest fees and other consulting fees for strategic initiatives, partially offset by $1.9 million of higher gains in the current year related to the sale of real estate. For the year-to-date period, the increase was primarily due to $12.6 million for proxy contest fees, professional fees for tax refund settlement, restructuring costs, and other consulting fees for strategic initiatives, partially offset by $7.8 million of higher gains in the current year related to the sale of real estate. Interest expense net decreased $1.5 million in the quarter and $2.2 million year-to-date compared to the prior year, primarily due to lower average borrowings. For the second quarter of and year-to-date fiscal year 2026, the company recorded income tax expense of $4.8 million and 2/10 of $11.7 million respectively, resulting in effective tax rates of 27.7% and 30.2% respectively. The effective tax rate for such periods differed from the U.S. statutory tax rate primarily due to the establishment of valuation allowance on cumulative interest deduction limitations from current and prior fiscal years and the non-deductible component of share-based compensation, largely offset by a favorable state refund claim settlement. For the second quarter of year-to-date fiscal year 2025, the company recorded income tax expense of $7.9 million and $21.2 million, respectively, resulting in effective tax rates of 27.6% and 29.1%, respectively. The effective tax rate for such periods differed from the U.S. statutory tax rate, primarily due to the non-deductible component of share-based compensation and non-deductible losses from the market performance of insurance products used to fund certain non-qualified retirement plans. The results of operations from the sale of our Del Taco business has been reported as discontinued operations for all periods presented. For the second quarter of year-to-date fiscal year 2026, there were losses from discontinued operations, net of taxes of $2.3 million and $19.1 million, respectively, compared with $162.9 million and $160.2 million, respectively, for the second quarter of and year-to-date fiscal year 2025. As of April 12, 2026, the company had $69.4 million of cash and restricted cash on its condensed consolidated balance sheet and available borrowings of $95.3 million under its $150.0 million variable funding notes. The company uses corporate-owned life insurance, COLI policies to fund our Supplemental Executive Retirement Plan, CREP, and Executive Deferred Compensation Plan, EDCP benefit obligations. The funding of these plans was well in excess of the related obligations at April 12, 2026. As such, following the second quarter of 2026, the company is in the process of withdrawing excess funding of approximately $71.0 million from its COLI policies, which is expected to be used along with cash on hand to prepay approximately $99.0 million of the 2019 and 1 Class A2 type notes in the third quarter of 2026. Operating cash flows decreased 44 department expenses compared with a year ago, primarily due to a decrease in working capital of $29.8 million, as well as lower net income when adjusted for non-cash items of $14.1 million. The change in working capital included the $35.0 million received in the prior year in connection with a supply chain contract, an increase of $12.8 million in franchise incentive disbursements in the current year, partially offset by a decrease of $23.0 million in income and franchise tax payments in the current year. Investing activities. Cash flows used in investing activities decreased by $13.8 million compared with a year ago, primarily due to purchases of assets intended for sale or leaseback of $5.7 million in the prior year, higher proceeds received from assets held for sale and leaseback of $3.6 million, and lower purchases of property and equipment of $5.3 million. Financing activities. Cash flows used in financing activities increased by $75.5 million compared with a year ago, primarily due to a $105.0 million debt prepayment made in the current year using proceeds from the Del Taco sale. The higher debt payments were partially offset by a decrease in dividend payments of $16.6 million, rolling over a $6.0 million repayment in the prior year on the variable funding notes, and a $5.0 million decrease in stock repurchases. On January 9, 2026, the company prepaid $105.0 million of its existing Series 2019-1 Class A2-2 notes. The repayment was made using funds from the Del Taco sale and is in connection with the company's ongoing prioritization of debt reduction as part of its Jack on Track plan. As of April 12, 2026, we did not have any outstanding borrowings and had available borrowing capacity of $95.3 million under our variable funding notes, net of letters of credits issued of $54.7 million. The quarterly principal payment on the Class A2 notes may be suspended when the specified leverage ratio, which is a measure of outstanding debt to earnings before interest, taxes, depreciation, and amortization, adjusted for certain items as defined in the indenture, is less than or equal to 5.0x. Exceeding the leverage ratio of 5.0x does not violate any covenant related to the Class A2 notes. Subsequent to closing the issuance of the 2022 notes, the company has had a leverage ratio of greater than 5.0x and, accordingly, the company resumed making the scheduled amortization payments on its 2022 notes and Series 2019-1 notes. As of April 12, 2026, the company had restricted cash of $26.3 million, which primarily represented cash collections and cash reserves held by the trustee to be used for payments of interest and commitment fees required for the Class A2 notes. The company announced on April 23, 2025, that it will discontinue its dividend effective immediately and direct a majority of those funds toward leverage reduction. As such, the company did not declare any dividends during the current year. The company did not repurchase any shares of its common stock in fiscal 2026. As of April 12, 2026, there was $175.0 million remaining under share repurchase programs authorized by the board of directors, which does not expire